Most people look at a property and see photos, amenities, and a price tag. Serious investors see a multi-layer financial engine with moving parts, sensitivities, and hidden leverage. Here is how high-level operators analyze property and how real wealth is actually built. A property is not just an asset. It is a three-statement system. Rental income is only the top line. The real figure that matters is net operating income after vacancy, maintenance, service charges, and rate adjustments. Your equity position changes constantly as the market moves and as your debt amortizes. Your personal loan-to-value becomes your risk profile, and cash flow is the truth detector. A property can appear profitable on paper while silently draining liquidity. Cash flow is what keeps investors alive during market cycles. Valuation is not guesswork. It is an equation. A property's value equals the present value of its rental velocity, absorption in the micro-location, expected service charge inflation, yield compression or expansion, and its long-term cash flow survivability. Anyone can pull comparable sales. Few can estimate intrinsic value under multiple scenarios. That is where the advantage is created. Every investor has a personal cost of capital, even if they do not know it. Your cost of capital is a blend of your financing rate, your opportunity cost, your risk tolerance, and your liquidity requirements. If your expected return does not exceed your personal cost of capital, the investment quietly destroys value, even if it looks profitable on the surface. This is why two people can buy identical units and end up with completely different outcomes. Your working capital determines how fast you can scale. Most investors underestimate the cash required to activate and stabilize a property. Between government fees, agency fees, initial equity, furnishing, maintenance reserves, and protection against rate shocks, working capital is the foundation of survival. Underestimating it breaks portfolios. Mastering it accelerates them. Leverage is a precision tool, not a shortcut. Leverage amplifies returns only when rental income exceeds financing costs, when growth exceeds drag, and when your holding power is stronger than market noise. Otherwise, leverage amplifies losses just as quickly. The right question is not how big the mortgage is, but what absolute return that leverage profile unlocks across a full market cycle. A property strategy without scenarios is a hope, not a plan. Serious investors model three futures: a base case, an upside case, and a downside case. If the investment only works in the upside case, it is not an investment, it is a wish. Real estate becomes extraordinary when you treat it as a dynamic, data-driven financial system. Not a unit with a nice view, but a cash flow engine, an equity machine, a leverage platform, and a long-cycle wealth accelerator. This is how portfolios grow from one property to 10, and how wealth compounds gradually. If you want a structured investment plan built around your goals, or a private breakdown of the strongest opportunities on the Dubai market, message us now.